Ladies and gentlemen of the crypto space, we're live on a Friday, September 15th at 12:32 p.m. It's a good Friday. Things have calmed down locally, as in the local time frame. The longer time frame, where we're heading into the future, is how we structure our capital. You don't structure capital based on today. You structure capital based on a rational time horizon. Now, that's going to vary from person to person, from the way people interact with markets. Could be a technical trader, in which case you're looking at the daily or the weekly. In 5 years' time, tell me there isn't going to be increased liquidity from a systemic level. I mean, even the Fed defines their inflation target as 2%. That's not even considering international inflation targets or the realities of where inflation lands. So, international global liquidity conditions will be greater than today in the future. So what we do from a technical perspective is inspect things to get a sense of current conditions, current directionality. While we're very confident of the path of market or the destination of markets in the future, what we need is the understanding of current conditions. That's how we find our comfort. Whether we're going to be heading down in the short term or down over a midterm time horizon, a week, a month, we know the destination. So what do we do based on shorter time frame paths that can potentially play out between now and 5 years from now? So that's why we're looking at data. Oh, I put the stream up early. I got a lot of comments. Let's see. Let's hit comments, and then we can just doing technicals today. Some interesting technical data. We'll get to what's going on with the move and the dollar, and we'll talk about potential paths. Bill Clinton's in the house. Hey, Cap, no question. Just wanted to thank you for continuing these streams. Have helped me stay rational and consistent. Hope you continue through the next bull market. Of course, we're going to have a lot of fun. This stream isn't going anywhere. Hey, Noah, it's less than a year. 1 million curve is going to get unlocked. What are you planning to do? Sell or convert? CVX Aura locking for another 4 years seems like a bad idea. No, well, I don't have a curve position. I purchased a permanently locked position that my expectation is to continue to lock. I lock maybe every month. I update my lock and I generate cash flow. Now, there's a binary bet. You could say that if the curve ecosystem continues to exist into the future and becomes infrastructure, then it will continue to produce cash flow on a weekly basis into the future. And that's what I want. So my capital, my portfolio is structured the way I'm hopeful for my future to be. And what do I want of my future? I want to click a couple buttons every week and have my income. So if I catch one protocol that exists in 4 years, in 8 years, in 12 years, and I'm able to click a button once a week, a couple of buttons weekly to generate my income, that's a hell of a business. That's a little bit of a different type of business as compared to a pizza shop or a yogurt shop, as my wife wants to start at some point. This is a financial business. It's a financial enterprise. And that's the case with all of these businesses. What do you think? Aave isn't a business. It's literally a money market. It's a bank. And that's what all of these are. All of these systems that extend credit in some way, shape, or form are types of banking infrastructure. So these are enterprise from a functional standpoint, just like any traditional company, any traditional equity, any traditional bank. Chase, JP Morgan, they all do the same shit more or less. So these are doing the same thing in a different way. So what will survive? It's a common theme we've been talking about. What will survive and what opportunities exist with what survives and considering their functionality, considering their investment potential. Is it capital gain strategy? And is that binary? Is that the growth versus value argument of the 1960s and 70s, times past? I think that's the case. I think we're heading from a growth structured capital market to a value structured capital market. Well, cash flow is significant once again, where the narrative shifts back to inspect the balance sheet, expect the health of the business, and how well the business is doing from an income and a capex standpoint, and bam, we land ourselves in the crypto markets where capex is non-existent and opex is non-existent. I think this higher interest rate environment over time, higher highs, higher lows, is very interesting. Now, it produces complexities from a sovereign balance sheet perspective, but that's separate and apart from what that directionality with regard to interest rates implies. Hope that helps. Critical mass. Honestly, I know it's off your radar, but would love to know your current thoughts on Spell. Spell is a CDP. Spell has shown to be resilient. It has attributes of survivability. It has an implementation that is investable. You can look at technicals and see the irrational exuberance, but what you have to do is obviously put a black box over the bullshit part of the technical data of the price action. From a revenue standpoint, I like the tokenomics and the way it's structured. So from a speculative standpoint, if it as a dollar liability, MIM, is effectively consumed in the future, it has investable characteristics because, to me, because of how the cash flow is distributed to owners. So that's a big deal. Now, obviously, it's a hell of a landscape of dollar liabilities. It's not just few. We're not in 2020 and 2021 anymore. There's a significant amount of competition. So that's not necessarily a bad thing. Competitive landscapes, you could very easily have many systems, countless systems that are successful. So these are just unknowns. And to me, probably this is a case of diversification because, like common Bitcoin narrative is the fastest horse. And yeah, that's been the prevailing narrative since the top in 21 where Bitcoin has been outperforming everything. So do you just concentrate into the fastest horse or do you diversify a bit? And that's an age-old question, something that cannot be answered. It's a subjective answer. So I have always had a high opinion of Spell. The rational exuberance created a fair amount of difficulty navigating the price action. But from a bottom perspective, like a bear market bottom, the question becomes how well does it do compared to its peers? And that's from a price appreciation standpoint and a capital gains perspective, or from a cash flow perspective. I think the entire space, broadly, generally, is positioned to expand with regard to its endogenous liquidity production, where dollar liabilities are printed using endogenous as compared to exogenous collateral outside the system, but collateral inside the system used to print its own dollar liabilities, much like you would describe an emerging market. There's great potential for it. Whether that potential is greater than or equal to peers, you'll only know from hindsight. No horn, no tails. Hey, Cap, what do you think about CVX right now? If you did not already have a stake in Curve, would you consider CVX? I grabbed my recent position in Convex at 270, 269, give or take. Probably should have paid more attention to what Olympus Dow was doing, and I could have got a bit of a discount. It is what it is. It's not the largest of positions, certainly not the largest in my portfolio. It's a historic quantity that I had at one point, so maybe I bought it for nostalgic purposes. Albeit, I think the tokenomics changes going on now are favorable. It will produce better price action for the asset, better opportunity for owners, and I think obviously, along with the entire Curve ecosystem, I think it's the fastest horse, and it has survivability characteristics written all over it. So I generally have a high opinion of it. So it's an entire conversation unto itself, Convex versus Curve, with regard to fastest horse or greatest opportunity, and that's not something we need to entertain. but you can compare to other federations and other upstart types of incentive regimes, but not necessarily comparing federation participants to one another. So, um, at one point I said, why own Convex if you could own just Curve? And Curve, the vote rentals have paid exactly what I speculated for them to pay, and they've continued to pay all throughout 2022, and 2023 thus far has certainly not been a disappointment. Hope that helps. Yes, spell governs MIM. Yeah, does MIM use smart contract liquidations? MIM has sociopathic liquidations. Now, it's a hard liquidation. So that's probably the most interesting thing with regard to CRVUSD and the llama, which is not a hard liquidation. So this is the conversation that I just mentioned that only has subjective answers. What's the fastest horse and how much diversification versus concentration goes into a portfolio? Only subjective. Good afternoon. Dan's in the house. Pleasure. Okay, nice to see you are still bullish on Curve. Will you double down now? I've been doing these streams 3 times a week for 2022, 2023. Bullish and bearish are not terminologies I necessarily subscribe to. I'm more interested in survivability, and I'm more interested in X, Y, and Z. How much does it cost? How much is it paying? And how likely is it to continue into the future? So Z is survivability. Is it going to survive? If it survives, it's going to become infrastructure. How much does it cost? How much is it paying? If I put $100,000 down and I'm going to get $25,000 first year, it has a 4-year ROI. It's paying 25% APR, and that's X and Y. And to me, 25% is significantly above the risk-free rate of return. So I'm exposing to principal volatility in exchange for a significantly increased rate of return. Principal will be volatile, but over the next 5 years, is the liquidity in the system not going to be significantly greater than today? It's going to be. So the principal is going to be volatile. Who gives a shit about the principal? It's kind of like the argument that sovereign bondholders will have. It's just HTM, hold to maturity. What matters, the principal value. I mean, obviously from a collateralization standpoint and, leverage loans and liability printing, it's significant. But a lot of the argument for sovereign debt is you buy $10,000 worth of sovereign debt that's paying 4.5%, and you hold it to maturity, you get your $10,000 face value, and you're getting 4.5% returns. And the principal, the volatility of the price point of the bond for resale at any given time is irrelevant because you're going to hold it to maturity. So that's a type of conversation you can have with regard to these types of assets over multi-cycle time horizons. A lot of folks are like, when's bottom? When's it going to go up? I'm thinking about 2025 and at least what can be considered the next cycle, but I'm really starting to think about, gives a shit about 2025. I'm much more interested in 2029 and 2030 because you're going to have these assets. If they're permanently locked, you married them. You own them. They're not a position. And you need to start to redefine these prevailing narratives. Don't marry your bags. No, don't hodl. No, those are shallow terminologies. That don't have a rigorous methodology and an entire story and narrative behind them. These aren't positions. You either purchase them or you don't. You purchase them. These are the characteristics of them and how they contribute to a portfolio from a value assessment methodology for a value assessment perspective. Purchase versus position. Sure, if you're only thinking relatively shallow from a capital gains perspective, yeah, don't marry your bags is probably really good advice. But I certainly am the last person in the room to be thinking from a purely capital gains perspective. That time will come when capital gains is on the table, and it's surely not now. Are you not concerned about upcoming AMM stealing volume from Curve? Last week, Curve was getting destroyed by Maverick and Dodo, stable pools with fewer fees. No, Maverick is not even remotely on the radar. Neither is Dodo. Maverick is an interesting topic. It has extreme capital efficiency, which is a great contribution to the ecosystem. So it's great technology. It's actually very stunning technology. So that's very meaningful. That creates a very liquid environment where flows can occur freely and you can have great volumes. So that's great. From an investment standpoint, there is no investment right now in either one of those. I don't really keep an eye on Dodo unless it's on Ethereum mainnet, and I really don't care too much. So Maverick's obviously on mainnet, but Maverick to me is completely uninvestable. I don't see any opportunity whatsoever. There's no cash flow potential. I'm not an active liquidity provider. So that's that. There's literally, it has no investable characteristics. There's no federation. There's no sterilization. There's no recycling. There's no vote rentals. There's nothing. So that's my criteria for something that has a capacity to be defined in terms of value. So I currently assign no value to it. There's literally no reason for it to go up other than speculative price action, which I'm not interested in. Hope that keeps it super duper simple. Volume will not be a meaningful revenue generator on long term. Look at Maverick doing 10x. Well, I hope my answer clarified my perspective on Maverick. Things can change, in which case I'm observing the market. I have my eye close on it, particularly because of the degree of capital efficiency it offers. And it's great tech. Cool. I've often said great tech doesn't mean it's a good investment. History is filled with great technology that was not a good investment. Raul, hello. Critical Mass, you're welcome. Dan, what are your thoughts on Convex proposals? Sounds good. It has Frax overtones, and it clearly sets a break between stake and voting. So I think this is a good change, and it should divert attention away from vote lock towards stake. So it's just going to isolate them. I talk about this in software development a lot. Separation of concerns. Why the hell is vote lock getting revenue? That doesn't make any sense. So this makes sense to be a good change, especially in that regard. Vote lock is you vote for voting, and you're going to get rental fees, and that's it. So a component unto itself, concerns unto itself, and you separate those concerns. Second one involving Frax. I may not have inspected granularly the second one, but I could always say, generally speaking, anything going on between Frax and Convex has to be constructive. Betting on survivability seems a loser's game now. Almost everything in crypto survives. Even pure scam coins are still around. Why not bet on profitability? No, that is generally not accurate statements. In 2018 and 2019, nothing survived. Nothing. There was no liquidity. There was no emerging market. You could not define this space as it currently is because this space as it currently is did not exist. 2018 and 2019 was a period where liquidations was purely price point driven, capital gains, and the cash sat on centralized exchanges. And with the opportunities gone because it's a bear market and price action was depreciative, the liquidity left. Who gives a shit about liquidity on a centralized exchange anyway? The narrative that emerged post 2020 is that of an emerging market where you have sticky capital and endogenous liability printing, which is very much akin to an emerging market, an actual sovereign nation, where collateral that exists in that nation is used to actually print liabilities of a currency. Either it's a currency, synthetic Ethereum for all I know, all I care, or obviously synthetic currency units from a sovereign nation, or synthetic dollar liabilities, which is obviously the most common and associated with the classical euro dollar system. So this is not 18 and 19. it is different this time. So obviously, what is different is can be very granularly discussed. Obviously, it's the same with regard to irrational exuberance and price action. That's par for the course with regard to volatile assets, but it's very different with regard to the stickiness of capital, the endogenous liability printing that occurs, and just you don't have the outflows. What was it, 25,000% increase in systemic liquidity since December of 2019 was a Twitter post I did a couple of times. It's in there, but it's something like that, something like a 25,000% increase in systemic liquidity, looking at Uniswap V1 history. V1, Uniswap V1. How many folks have been around since V1? I remember late 2019, and it was pre-launch. It's pretty wild back then. I remember seeing like $500,000 worth of volume or something, and it was nothing. And no one saw what was coming. No one saw what was coming. And it doesn't matter. Almost everything in crypto survives. Yeah, no. Only things that have perceived value survives. And it's not only about survival, it's also about the structure of the instrument. I don't give a shit if Dogecoin or Shiba Inu survive. I don't see value in those assets other than from a capital gains perspective, of which that is not the methodology in which I use to engage with the markets. There's nothing that I see as valuable with those assets. They don't do anything that I'm looking to do. I've described very explicitly that my intention in 2025 and then 2029 and 2030 is to have a setup where I click a couple buttons a week and I get my cash flow. Can I do that with those assets? No. So I don't really care about tokens. I don't care about price action and volatility. I don't care about 10,000x on next Bob shit Inu Sonic 10,000 coin. I don't care. What I care about is my methodology, my narratives, and having a good story to tell. That if any one of these assets that I've chosen as part of the current composition of the portfolio survives, it's going to continue doing what it currently does, except in an increasingly liquid environment. That's why I've often said, if it's not paying now, there is no guarantee it's going to pay in the future. I mean, look at Uniswap. How many times have they tried to turn on that fee switch? It's not going to pay in the future. They're not going to turn it on. It's probably the same with Aave too. It's possible. Maybe it's a little bit more decentralization in the governance, but I'm not gonna wait. I'm not gonna hope. I'm not gonna hope that it pays significantly in the future. Link is interesting, maybe, but it's not paying now. And therefore, I can't make a good decision. I don't want to buy the thing that's paying, and because everyone's like, oh, it's gonna pay in the future for Link, and the staking is on the table, and there a lot of the arguments are it's significantly undervalued and get the significant price appreciation. That's not enough for me to warrant allocation of capital that it's going to appreciate and maybe pay 5%, maybe 10%. How much did it pay through 2020, 21, 22, 23? So I don't have any history to go on. I have history to go on with the stuff that I have in the portfolio. And that's meaningful. History, precedence, and it has paid. It has paid significantly. So therefore, if it's an immutable contract, it's going to pay significantly in the future if the conditions are comparable. And obviously, the story is the liquidity conditions are going to significantly improve in 5 years, in 10 years, nominally, I might add, but that's all that matters really. So therefore, the cash flow will continue and be greater than or equal to past experience. Hope that helps. Profitability. I think you're still talking about Maverick. Maverick's not profitable. You can't buy the MAV token and get anything. You get nothing. So I hope that answers that question. There's zero profitability there. 19 people in the stream, 9 likes. Hit that thumbs up button. I appreciate all of you. So all this time we've been looking at the Ethereum chart. We're looking at the monthly, and we've pushed a little bit above the time-weighted average price. We more or less have this series of higher lows. Notice there's 15 days, 8 hours left on the monthly. From an Ethereum technical perspective, we'd like to see it close with the time-weighted average price. This little bit of red over here turn green. I'd love to see a close at or above the previous close, which is 1643. We're at 1622, so there's 15 days left in this candle. Bitcoin is a very similar chart, sitting just below the 50 on the monthly and the TWAP on the monthly, nicely above the 100 on the monthly. So where's my head at with regard to a couple of comparisons between last cycle and this cycle? So notice the push below. We'll stick to the monthly for this conversation. Notice the push below the TWAP. The push below the TWAP was much less severe as compared to the previous cycle, and especially considering the push above. The push above, look how far the push above went back in May of 2019. Look how deviated it is from the TWAP. And what have we been talking about a lot lately with regard to technicals? Any deviation from the TWAP to the upside is not sustainable. It will mean regress to the average price. So, and that's exactly what it did, coupled with this obvious divergence in March of 2020. March and April had rebounded because of the significant intervention into the liquidity conditions. But look at this. Look at this. Even the mean regression had 1, 2, 3, 4 months of support. We had the deviation and right back above the TWAP. So barring any significant systemic liquidity disruptions, even back in end of 19, heading into the liquidity disruption in 2020, we had great support above the time-weighted average price on the monthly chart. Now, what have we seen so far in 2023? Liquidity intervention all over the place in the federal banking system, in the corporate banking system. So this is a relatively comfortable position for me to be in. And that's why I'm looking at technicals. I'm not looking for entry prices. I'm not looking for sell prices. I'm not a trader. I'm looking to find comfort. So when I look at this technical chart, looking and thinking about the conditions that caused this type of price action back in 2019, I find great comfort. We did not significantly overextend above the time-weighted average price. And we had a significant mean deviation to the downside of the 50 SMA, again, on the monthly. So when we push back above, so this is a big sell-off. This is a large accumulation of fresh owners to such a degree that the average price went above the average price. So mean regression to the downside, mean regression to the upside, breakout. This is about a retest. So, 3, 4, 5, 6 months down the road, what you want to see is it hopefully hover around the time-weighted average price. If we're in January, February, and we're about $25,000, that's a remarkable technical setup heading into the sovereign refinancing cycle, where my estimates, it's 10 plus that need to be refinanced, yet alone yearly deficit spending. So we're really talking about probably 12, 13, 11.5 to 13 trillion dollars that needs to be issued fresh on the run. And what do you do with fresh on the run treasuries? There goes the liquidity. And that brings us to the chart of the day. See if there's any comments that I missed. And we'll hit the chart of the day. Long the revolution. Morning, friends. No horse, no tail. Meme coins don't have cash flow. It's the survival of cash flow that's important. To me, that's the only thing that's significant because that's all I care about. I want returns. I look forward to a time period in the market where there's significant appreciation, and we'll play that. We'll see our ascending triangles, and we'll capitalize, and we'll get 10, 20, 30% in a week on an ascending triangle breakout of the crypto markets. But that's not passive. And what I'm looking for is the reemergence of passive. So passive in traditional finance is the 60-40 portfolio, and by all measures, bond market looks to be going higher over time with regard to interest rates. Higher lows, higher highs, so price points are going to go down. 60-40 portfolio construction is done. So there's going to be a significant reallocation of capital over time from sovereign debt into other assets that are going to be the fastest horse. Capital flows from underperforming to outperforming. So if sovereign debt hits the lower lows and lower highs over time and price point, underperformance implies liquidation and reallocation to things that are outperforming. That's just pretty clear, especially in the technical data. If you look at the 10-year, you could see it written all over the place. I mean, you broke right through the 200 on the monthly. You broke out, retest, higher high, one, two, retest, and we're basically at a higher high. Holy shit, what are we up, 0.75% today? Jeebers. We hit that higher high. Are we there? Are we there at that higher high from October of 22? Look at that ceiling. We're about to hit a double. So breakout, retest, higher high, breakout, retest, higher high in 10-year yields. And there's no going back to normal. There's no this breakout above the 200 SMA on the monthly didn't occur. This is a trend violation. This is a structural infraction. There's no return to what was normal. The bond market has gone through, if you zoom out and you look at the TWAP, so check this out. Let me do you guys a favor and peer through the bullshit. Here's peering through the bullshit, and let's get rid of the SMAs. This is your bond market. From 1950 to 1991, you had increasing yields. And then from 1991 until 2021, you had decreasing yields. Now, this is the 1-year chart, so obviously the TWAP is going to be lagging significantly as compared to the actual yield point on this chart or price point, whatever. So this is the first time in 2191 in 30 years that you've had a green TWAP. So obviously it lags because it's been like 41 years with regard to the actual chart. But it takes a long time for the yearly TWAP to catch up. It's a lagging indicator in regards, which is why mean regressions occur and head towards it. This is the first green TWAP in 31 years. That's crazy. So that's a structural change, a structural deviation. Higher highs, higher lows on bond yields is the base case. I don't see a path, and that's all about assessing conditions to assess if a path back to lower yields, lower highs, lower lows is possible. It doesn't make any sense. Sir Joe, pleasure. That's fair. I just hope the story you'll tell won't be a tragic one. It's not. We've already made our money in 22 and 23 as folks are running around frantic over depreciation. If you played your cards right in 2020 and 2021, you made your money in 22 and 23. I have absolutely zero to complain about 22 and 23 based on my methodology. By Ethan Stake, you can press buttons weekly selling your rewards. Yeah, 4%. Listen, 4% is cool, and I like that with Ethereum. I'd say about 5 mil. 5 mil, and you're making about 200 grand a year. So 5 mil is a good target. So you got to assess your opportunities based on your cash flow needs. So obviously the problem is my methodology is not really applicable to the smaller portfolios. If you have 10 grand, you can't do any of this. If you have 10 grand, you're literally hoping for a technical analysis moonshot where you can turn the 10 grand into a half a mil, and then the half a mil into 1 mil, and then the 1 mil into 3 mil, so on and so forth. So you have to respect the size of the portfolio. And you can't have expectations that exceed, that are irrational. Your expectations have to be attainable and reasonable. So if you want like 100 grand a year on pure Ethereum, which is relatively risk minimized portfolio structure, I'd want like 2.5 mil worth of Ethereum. That's cool. I don't have 2.5 mil worth of Ethereum. So I have to explore different opportunities that have a capacity to meet my expectations such that I'm not disappointed. So that's why XYZ exists. How much does it cost? How much is it paying? And what's the likelihood of it continuing to exist into the future? And that's why I talk about immutable contracts so much, because an immutable contract is guaranteed to exist into the future. And to me, that's everything. That's the biggest investment opportunity I've ever seen. Combine immutable contracts with immutable monetary policy, that's crazy. And it's paying now? So it means it's immutable, it's going to pay into the future. So that means in the future, it's going to be exposed to the liquidity conditions of the future. And I'm like, oh, I've taken, what's the, yeah, price action risk, but you don't have risk that it's not going to be there. You have time risk, that there'll be a period of time where you have decreased cash flow and you have to compensate, as with any period of austerity. Cash flow will come down, contracts exist. Cash flow will come down. Contracts are paying. Liquidity conditions start to improve. Contracts exist. Liquidity conditions start to improve. Cash flow starts to go up. All the while, it still exists, and it's mathematically guaranteed to exist because that's the whole point. That's the biggest opportunity with regard to these contracts. Get rid of the people. Get rid of the subjectivity. There's no humans. It's just software. I've never seen anything like it from an investment standpoint. Can you please explain the Convex proposal above? I don't know it off the top of my head. Well, I'll go off this. I don't want to take too much time. I want to get to the move chart and wrap it up for today. But Frax's protocol and liquidity means everything. Frax as a stablecoin is one of the few stablecoins that did well during the Luna phase because of the amount of protocol and liquidity they have. I put out, that stablecoin paper, what was it, like a year and a half, 2 years ago? And it's still relevant to this day. If a stablecoin has enough protocol and liquidity such that 100% of all circulating stables of that denomination can be sold, then it literally can't lose peg. So I find that quite fascinating. So from a stablecoin perspective, protocol and liquidity is everything with regard to resiliency. And resiliency is everything for a stablecoin. You can't lose peg. You need to dominate peg. You need to own peg. So that was my whole stablecoin paper, was to own peg 100%. So how do you do that? That might be, still, I think it's an interesting idea I had. So you have to dominate peg, you have to manage peg, and obviously they have done probably better than almost any endogenous dollar liability in the entire crypto emerging market. Why? Because they've talked about that, and that was the case during the Luna phase. They had enough protocol and liquidity that 100% of Frax could be sold without them losing peg. So Sam really has these core tenets in mind that should be characteristics of successful and resilient protocols. So that's quite interesting where Frax is, therefore where Frax is heading. Frax is probably the only protocol that that is not cash flow productive. That's part of my portfolio composition. Maybe I acquired it a little early in the evolution of my methodology, but of all protocols in the crypto markets, is it not the most grandiose scale and scope of everything, especially the newer versions? Was it FX ETH v2 and Frax v3 with regard to the completely, no multi-sig on governance? That's crazy. That's a big deal. That's a bigger deal than probably most will realize. That means it's there. It's set in stone. The governance does what it does, and it can't not be modified by any subjective opinion. No multi-sig. That changes everything. And when I say changes everything compared to traditional equities, and boards and CEOs and executives. No, immutability. That's everything. This is the opportunity that I do not see anywhere else because of that. Immutability. No multi-sigs. Get humans out of the picture. Humans are the problem with your investments. Humans are the problem with investments. Period. Hope that helps. Is it worth accumulating anything right now? Listen, the market is a ghost town. Nobody's here. Nobody's on this stream. Discord has shriveled. Crypto Twitter is a ghost town. And it's not for me to ever say. I have no idea what anyone should accumulate. Depends on your goals. Depends on your portfolio size. Okay, you have $1,000,000, and all right, there's something that's producing 20%. You could have $200,000 a year income. Okay, that's pretty interesting. If you have $1,000,000 and there's 4%, 40 grand, is that enough cash flow? Is that adequate to consider? You could also buy a pizza shop for maybe $600,000, and depending on the neighborhood it's in, maybe you can make 200 grand a year, so you're making 30% of the money, doing a shitload of work, having a lot of staff. Or you could buy a property in a neighborhood, $1,000,000 property, rent it out for 5 grand a month. 5 grand a month is 50 grand a year. You're making 5% on your money. That's pretty shitty compared to the risk-free rate of return of 4.5% on 10-year bonds. So I'm not too fond of real estate in that regard. I think it's relatively shitty returns, albeit it could potentially be very low maintenance with the management companies that is offered that are available in the real estate markets. So that's why no matter what conditions we have in the markets, this is the only market that I see extraordinary opportunity. This is why I have my comfort. So I look at these technicals to find my comfort. Comfort allows time to pass. Time does the work. So that's not necessarily, that means you're early on in your progression in navigating these markets. If you're looking to acquire and you don't know what to acquire, and I appreciate that. We all have our start. Look at that Gwei. Look at that 115. Something's going on. Maybe something in the charts. Maybe we'll take a look. But this is not necessarily a time to be accumulating. This is a time to find comfort and let time pass. And you really need to assess size of the portfolio. Because 10 grand doesn't do anything. 10 grand is probably best, like what was said earlier, is probably just like Ethereum, and it's going to be super volatile. Maybe 10 turns into 6, turns into 60 at the top of the next cycle. My target, what's your target? Targets, you have to make sure your expectations don't exceed what is rational. So my target on Ethereum returns by top of market cycle, end of 2025, whenever the hell it comes, I'm looking for really a 5x on Ethereum. If I get a 5x on Ethereum, that's meeting my expectations. I don't think that's the top, but I don't give a shit about top. I don't want a 10x. And what is a 10x? You're talking about denominated in dollars, which means liquidating at an opportune time. So no. So to what? Accumulate more dollars. So to me, that's not a sustainable methodology for engaging with markets. So the way I frame it is in terms of my goals in real life. So I have certain things that I want to pay off, like debt. I can service my debt. Everything. I'm cash flow positive. I'm employed, but it would be nice to get rid of certain debt positions. So that is my expectation, and that is my goal. And to liquidate Ethereum at an opportune price point, that's the terms in which I think, where I can eliminate certain quantities of debt. So it's not in terms of total dollar return and to just have more dollars. What is that they always say? Dollars aren't an end unto themselves. You need to think in terms of real world use cases, and that helps you set your framework for where your expectations should be and if they're rational or not. Hope that helps. I know it's a complicated topic, and I'll continue to talk about this, and please ask these types of questions, and I'm more than happy to speak on it, Kingsley, anytime. Morning cap, we can do better. We could always do better. And the most important thing right now is to let time pass and find comfort. Let's see. I'm not leaving. Not going anywhere. Let's look at the final chart of the day, ladies and gentlemen. And this is why market conditions have been comfortable the last couple of days. Let's put the price action back on. There you go. So it's the move indicator. The move indicator coming down to 97, which is a forward-looking indicator of basically increased liquidity conditions. If bond volatility is coming down, it's a precursor. It's the initial sequence of events that's needed for offshore dollar printing. And obviously, there's a variety of factors involved, particularly the respective interest rate of the sovereign nation in which the dollar liabilities are printed. So there's arbitrage opportunities there. You know, if the interest rate in Britain is whatever it is, and it's less in Singapore, maybe you print your dollar liabilities in Singapore, but that involves you having banking access in the respective sovereign nation. That being said, that's the conditions that this indicates. Let's go over to the weekly. Oh, I need the moving averages. So this is the lowest the move indicator has been since March of 22. And we're obviously in September of 23. It's a year and a half. And this finally is starting to come down. Finally is starting to come down. So this is maybe what regulators are talking about when they say, you know, a relatively soft landing. Because if they're able to finally get their control or take back control over bond volatility, and listen, you get 80, you see a 70 print on this chart. What do you think happens to systemic global liquidity? Now all of a sudden bonds are like, oh, we can use them again. Oh, and international countries are easing because they can't dare increase rates. I mean, ECB's pushing their luck getting the rates up to where they're going with the recent 25 basis point hike. But you know that their economies are going to fall apart for the same thing we're talking about inside the United States. How everyone's like, it's all going to fall apart. You think it's going to fall apart first in the U.S. or outside of the U.S.? It falls apart first outside of the U.S. So no one's going to out-hike the Fed. That's the way it is because the whole world is dollar denominated. So the question becomes in regards to currency, to liquidity. So that's the contradiction. Move leading indicator on future liquidity conditions from a liability printing perspective. You know, the DXY is still elevated, and that's obviously because of Japan. Let's see what happens. And that's really why we have to look at Japanese interest rates on JGBs. And then if they get it under control, then the DXY comes down. So we're at 14.6, 14 days, 6 hours left on the monthly candle on the DXY. So what you're looking for here, it takes time to play out. Like, for instance, you see move come down to 97. You see at the end of the month, at the end of September, you see the time-weighted average price hold as resistance. So that means you had a breakdown, and what was that, 8 months below the monthly TWAP. Hold as resistance, retest to the upside. Then heading into June of next year, another 6 of these candles. Maybe see a lower low. Maybe you see the 50 on the monthly hold as support. But that's the time period it takes for these types of charts to play out. Maybe you see the 100 SMA hold as support. But you know what happens between now and then? And this is why you get that potential, you know, the world is ending, the financial markets are going to crash, and then everything just rips to the upside. Everything just goes absolutely rocket bullish. And then, guess what? Then you have a credit event of some kind. And then the hot air comes out of the markets. You get your liquidity cascades, your capital destruction, and equity markets finally roll over and do what everyone said they were going to do. So those are the paths. And that's the whole point. These are the potential paths that can play out. We need these months and these candles to see what they do. And we look at this data to find our comfort. All right, so they got a shitload of paths that can play out. Look what the Fed did back in early this year in March. They papered over hundreds of billions of dollars worth of banks. So This is a managed liquidity environment. There's going to be liquidity disruptions. They're going to suppress bond volatility. They're going to have to figure out what the hell is going on with the currency market, because otherwise you don't have foreign nations that are able to supply you with goods and services. Because in the end, the dollar doesn't lose its value. There's nothing left but the dollar, because this chart that we're looking at is a relative value. If the U.S. prints, this chart comes down. This chart comes down. Nominal prices on assets go up. Dollar comes down. Foreign fiat has more purchasing power. Global systemic liquidity conditions improve. So, complicated. But there's a lot of, it's all causality. It's all cause and effect. Everything pushes and pulls on something else. Knock-on effect after knock-on effect after knock-on effect. Hope that helps. Kingsley, I think the market could surprise us all before the end of the year. Yes, I see that as a path, just as I just described. Move comes down. Let's say we have another slug down on move, like down to 90. DXY at the end of September holds the monthly TWAP as resistance. Let's take a look at the weekly. We're above the 50 on the weekly, but let's say it holds the monthly TWAP as resistance. Weekly is a failed breakout, pushes below the 100 on the weekly and pushes down towards the weekly 200. Weekly 200 is at 98, so that's more or less the 50 on the monthly. So look at that. Weekly and monthly have a nice rhyme and reason. Monthly TWAP holds as resistance, pushes down towards the monthly 50. And this is heading into like probably end of the year, December, January. There's plenty of technical paths available here for a significant run. And there's obviously all the macroeconomic setups for capital destruction and liquidity volatility. There's plenty of candles. So look at the monthly chart. Each one of these candles is one human month. So it's very hard to really wrap your head around these types of time frames. Sometimes. Always. The last one in live, accumulating cash, Bitcoin, Ethereum, and dollars. Sounds rational. Sarko, always a pleasure. 22 people made it to the end of the stream. Must have been a good stream today. Appreciate all of you. 14 likes. Hit that thumbs up button. You know the deal. Tell everyone to subscribe. In the description is a link to the most rational community in the entire crypto space. Shout out to Hero Network. Appreciate all of you on Discord. Enjoy your weekend. Catch you on Monday.